This was probably the most widely anticipated statement. Reserve Bank held rates today. Going forward, we will follow developments on commodity prices, especially food and oil, even while tracking inflationary expectations and external developments. Of course, the implementation of the pay commission proposals and its effects on wages and rents will also be a factor as we consider policy in the future. However, we believe its effect on aggregate demand will be offset by appropriate budgetary tightening as the government stays on its fiscal consolidation path. Now, we are focusing on transmission. Thus far, we haven't seen, we've seen barely half the interest rate cuts since January pass through. We're working with the banks on a new methodology to determine the base rate. It'll be based on marginal costs, and it should be put out sometime this week. We're also, the government is considering the small savings rates and tying them more to market interest rates. And I think both these actions will help transmission. Also, banks are currently engaged in a process of cleaning up their balance sheets, and as they clean them up, they will have more room for fresh lending. We will use the space for further accommodation when available, while keeping the economy anchored to the projected disinflation path that should take inflation down to 5% by March 2017. So that's broadly the gist of the policy statement, and I'd be happy to take questions.
Nisha. Nisha Podar from ET Now. Governor, you've paid a lot of emphasis on vigilance on CPI inflation. And you have, if I'm not reading it incorrectly, you've been tentative about accommodation in future because you have specially mentioned accommodation when available. I just wanted to understand your future stance, because it has been a status quo this time around, on whether it will depend a lot more on transmission, CPI, which you have said will plateau out, and also, are we already prepared to deal with an imminent Fed liftoff, which is going to happen? So are we going to wait till February for any more measures to be taken, or after a liftoff really happens, there could be something anticipated earlier because our economy needs it?
Okay. First, we are still accommodative. I think that is very clear. We're always vigilant, so this is not anything new. We are vigilant. There are obviously both upside and downside risks to consumer price inflation. We've highlighted some of the sources of risks going forward. One could imagine that there could be downside risks from, say, commodity prices, especially oil. But of course, given where oil is produced, there are also potentially upside risks if there are political events that constrain the supply of oil. So vigilance is always needed. Now, as far as you ask questions about when the next rate movement, etc., what we've said is, when times are warranted, we are always prepared to move off cycle. But when times normalize, we prefer staying with the policy cycle rather than move off cycle. Of course, when we use the words external developments, one of them is what happens to the Fed policy rate hike. Our sense, however, is that's probably even more widely anticipated than our statement today. Now, of course, there are some residual uncertainties about what the Fed will do. But my sense is, as I've said before, after an initial bout of volatility, we probably should see Indian markets stabilize and come through. So it's not, as I've said before again, the central factor in our deliberations going forward. Would you like to add anything? What's that?
Tentative on accommodation going forward, because you used
I
the
think
word benefit.
I think I've said it clearly. I'll say it once again. We are in an accommodative stance.
I think the way to put this is that, because we don't reduce interest rates, it doesn't mean we are not accommodative. And I think the language in the draft, in the policy statement, suggests that if and when space opens up, we will do what is required to ensure that both the inflation objectives as well as promoting growth on a durable basis will be facilitated by the RBI.
That was Dr. Patel, Deputy Governor. For those who are listening in, Lata?
Actually, the statement says when, but you now said if and when space for accommodation opens. I just want to know if that means something more.
One of the dangers of doing nothing is then you start parsing every word. I think the statement reflects a fair amount of deliberation, and so that represents our stance.
No, that wasn't my initial prepared question.
Okay, so this is question 2.
Okay, no, not at all. Well, actually, the previous policy said that RBI will look at the 1-year forward T-bill rate and subtract from it the 1-year forward inflation, and you want that real rate to be, between 1.5 and 2. Now, today, the 364-day T-bill, the 1-year forward rate is at 7.2, and your 1-year forward going by the fan chart is 5%. So actually, we are at 2.2 in terms of a real rate. Looks like you have passed up space to be accommodation. I wanted your comment, but if it is that you are looking at the 7th Pay Commission, I wanted to know whether you would only look at the 3.5% fiscal deficit number, or you would also ponder on the quality of fiscal consolidation. At any rate, what is the RBI's assessment of the impact of the 7th Pay Commission on inflation, both rent and wages?
Right. First, as far as those differentials go, we're not looking at it on a day-to-day basis. It's a rough indicator of what our where we would like to be. As far as the fiscal deficit goes, clearly both the quantum as well as the quality matters, and that is an issue which the government is fully seized of. I'm hopeful that while maintaining the fiscal consolidation path, the government can also maintain the quality or enhance the quality of the budget. So it is clearly an issue that they and us will both be looking at.
The impact of the 7th Pay Commission on inflation, what's the RBI's assessment?
Well, so let me also ask Gurjit to chip in, but in the broad sense, I mean, yes, there's going to be additional expenditure, but there will also, it will be offset presumably by either additional revenue raising or cuts elsewhere so that the fiscal consolidation path is maintained. So in that sense, we don't feel there will be a significant effect on aggregate demand, provided, of course, you maintain the fiscal path. Of course, investment in some ways may be higher quality than certain kinds of spending, and therefore one would hope that you would uncover space elsewhere for the public investment which we really need. And I think the government has taken a number of these into account while anticipating the consequences of the pay commission. So let us wait and see what happens. Ojit, would you like to add?
No, just to say that in the medium-term fiscal policy of the government, some of this was already anticipated. So it's the baseline has some of this already baked in. One impact that will be felt through the CPI index would be via the house rental allowance. But that's a one-time level change, and unless there are wider externalities, we will most likely look through that. But you will feel it in the index through the housing subcomponent of the CPI combined index, because they do sample a fair bit of government housing in the sampling frame that is used, and that impact will be felt from April onwards for 6 to 8 months, and you will see an index change there, but that is likely to be looked through by the RBI. Thank you.
Vishwanathan.
Thank you. So I want to understand what is RBI's assessment about the current growth scenario. The latest GDP figures come at 7.4, but as we have seen, some of the key indicators do not really correlate with these kind of high numbers. For instance, corporate trust, earnings, bank credit growth, auto sales also have been picked up as well. So do you believe that the growth has taken firm hold in the economy, or still there is a large disconnect between the GDP and the other indicators?
No, I think it's very clear that we are in the process of a recovery. We're in the midst of a recovery. Now, there are areas of weakness. There are places, of course, where you would, agriculture, for example. Agriculture is growing relatively weakly because of the monsoons. Allied activities, dairy, etc., growing more strongly. But as a result, rural demand is somewhat weak, and you see non-durable consumption, for example, relatively weak. Set against that, capital goods has grown fairly strongly. Public investment seems to be growing quite strongly. So I think what we have is an economy which is well and truly in recovery, but with areas of weakness. And hopefully, as we go forward, some of the areas of weakness will turn around. For example, with the kind of investment that is contemplated, construction may start picking up more strongly, and that will be very helpful. Perhaps with the kinds of measures that the government is taking, as well as, for example, on low-income housing, the capital requirement measures that the RBI has announced will have some boost to housing.
So many. Bijoy?
So Bijoy from Cogensis here. First of all, because you mentioned the marginal cost of funding linked base rate, do you think banks are ready to handle ALM management? There's no liquid OIS market at this point of time. Plus, there will be a direct impact on NIMs at that point of time. Do you think Indian banks are ready for that? The other question is slightly old in that sense, because for the last 4 years, savings bank deposit rates have been deregulated, but there has been, and somehow all the banks seem to have figured out that 4% is the best rate to have. Clearly, that cannot be a coincidence. So, at any point of time, has the RBI wondered about why the banks are doing this, and has there been any conversation with the banks on that? Also, on ARCs, you said that there was.
There are three questions there.
Yeah.
Okay.
ARCs, you said that there was some discussion happening on change in promoter norms for ARCs to enable international players to also come and take a stake in it.
Yep.
Thank you.
The first question was on the marginal cost pricing. Yes, as they move towards marginal cost and eventually a market benchmark, both of which will be enabled, they will have to pay more attention to asset liability management. Clearly, they have the capabilities. The question you asked is, are there the instruments? But, demand creates a supply. When there's no demand, there's obviously no supply. There obviously, as they start looking for these kinds of instruments, others will start creating them. So I have no doubt that the markets will become more vibrant as a result of what the banks will need to do to manage the assets and liabilities mismatches. As far as the second question goes, you asked, savings rates at 4%. I don't want to, conjecture why they've been stuck at that rate for so long. Of course, as you know, perfect competition will also get you the constant rate across the system. I'm not saying there is perfect competition, but we have to, it is something that perhaps in the future we could also look at, but I don't think we should presume, which you seem to be hinting at, that there's some misbehavior right off the bat, but it is something that we can look at. As far as ARCs go, we're very open to entities who want to set up as ARCs. There's a process of licensing. They have to apply. But if entities want to put more capital to existing ARCs, get licenses to become new ARCs, we are very open to it. And especially, I mean, if there are foreign entities that want to bring in more capital into this business, it's most welcome.